would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to a Friday edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Another week under the belt, folks. I hope you've all been able to achieve your goals for this week, or at least make really good progress on the ones that are going to take longer than this. We're coming in on the cutoff point for me in terms of the latest I wanted to list my property for sale. So this is going to be a big weekend for me in terms of things I want to get accomplished. And I'll, of course, give you the update when all that stuff is ready to rock and roll. And also remember, today is the last day that you will be able to take advantage of the opportunity to be included in the drawing for the $50 Amazon gift card for the month of June. I'm going to do that drawing today at 5 p.m. Pacific time today. Now, to join in, all you have to do is go over to therebelbroker.com. Click on the big red button at the top of the page titled Take the Survey to Support the Show. Use the same email address both times you're asked, answer a handful of demographic questions, and as long as you do all that and you use the same email address both times, you will be accomplishing two things. One, you'll be entered for that $50 Amazon gift card. Two, you will be helping the show grow, and I do truly appreciate it. That's one reason why I wanted to kick in the whole $50 thing, because I'm hoping that it just encourages more people to get out there and help the show grow. Okay. If you're interested in getting more data, more stuff, you want to get some exclusive video content, that type of thing, you should head over to your cell phone or to the website. You can go to therebelbroker.com as well. Go to the show notes. You can click on Join the Rebel Underground. There's a little button there somewhere midway through the show notes for today's show and just about all the shows for the past month. Or you can text the word Rebel Broker, all one word, to the number 44222. That's text the word Rebel Broker to the number 44222. Follow the prompts. It'll let you know that you've connected with the right folks, give them the information they need, and you will be in. And from then on out, you'll be a member of the Rebel Underground. And again, just to remind everyone, this is not something where you're going to get spammed. In fact, I think since I started the Rebel Underground, I think a grand total of 3 messages have gone out to the group. I definitely have plans for more give and take with that special group, but just haven't really implemented all that yet. And right now there is exclusive video content just for the folks in that group. So that's and I don't share with anyone. I don't sell your information. So don't worry about any of those kinds of things. And head on over and join in and see if you like it. You won't even know if you like it at first, because all you're going to get is that one message. And then from then on, it's pretty sparse until we get things rolling a little bit more. Okay. The other thing you can do while you're at the site, if you are interested in doing so, is reaching out to me. You can click on Contact in the menu bar. Send along any ideas, suggestions, observations, or questions that you might have, and I'd be happy to respond. Interesting news today, sort of on the political side of real estate. I believe it was the Senate that passed the first step in repealing a lot of Dodd-Frank. There are things to say about Dodd-Frank that are reasonable in terms of wanting to limit risk, those types of things. Frankly, I don't like either thing. I don't like Dodd-Frank, and I don't like a lot of the stuff that they're talking about replacing Dodd-Frank with. I don't like anyone being able to take these kinds of risks with your money, which is what it is, because we always end up on the hook. We end up on the hook for billions and billions, sometimes trillions of dollars when things go wrong. And that's not the way it should work. The safety nets should be supported within the industry that benefits from it, right? Like insurance payments. They should simply be required. The lending institutions. Well, that could be a much longer show. The primary problem with the way things are set up now is the secondary market, where originators can write a loan and then hand off all the risk to another entity. And guess who that other entity is? Well, through government-sponsored entities, it's you. And that's what got us last time. So that there needs to be a complete overhaul of that kind of stuff because the bottom line is the taxpayer shouldn't be on the hook for this stuff. So that's kind of one of the big things. Nothing has actually happened yet. It has to go through both houses. And by the time it comes out the other end, I'm sure it'll be very different. So as soon as we actually get a little bit more solidity, I guess you could say, in what's going to happen, I'll be sure to share that with you here because who knows what it might do in terms of affecting lending and borrowing and all those kinds of things. My biggest concern is that it will actually kick into high gear more risky lending. And that could end up really fueling things that are already bad. So I think this is something that anyone who is involved in real estate, whether you're a buyer, whether you're a seller or you're an investor, no matter what aspect of real estate you're interested in, the potential effects of this move could be gigantic for everyone. So we'll absolutely keep you in the loop on what happens there. Oh, and a correction, it wouldn't have started in this. It would have had to go through the House. All bills of that kind would have to originate in the House. So there you go. It still now has to make it to the Senate, as I mentioned before. It has to go through both houses and go through the usual political massage. So as I said, I'll keep you all updated on that one. Now, the first thing I wanted to cover comes to us from Realtor Mag at realtor.org. One of the things that we've talked about here, and the reason we've talked about it so much, has been the supply side in terms of more people building homes, right? Because you can control that. You can and I suppose you can to some extent on the existing home side, but it's more nuanced on that side, right? If you're going to make it easier for builders, that's just a question of easing regulations or making it easier to get permits and sort of getting out of the way and letting them get in there and get stuff going. And then that results in more houses, right? So it's one of the easiest sides to tinker on if you're someone who wants to tinker. The other side of that equation, also on the supply side, has been what would encourage sellers to sell. Now, someone like me who gets maybe a little obsessive about data and looking at markets and seeing what kind of things might nudge things one direction or another, who ultimately comes to the decision, as I pretty much have recently, that this is not a sustainable thing that we're having happen in terms of the level of growth. And it's also unbalanced, right? This level of low inventory will not last. Homes will get built. It's going to happen. Of course, if it takes a long time for that to happen and it flattens things out at a much higher price, well, maybe I've missed out on a higher amount. But my feeling is that particular equation doesn't operate in a vacuum. There's a lot of other things going on. We've got tons of car debt. We've got tons of school debt. We've got tons of debt. We've got tons of HELOCs getting underwritten. We've got all these things happening that create a scenario where I think there's a higher probability that things are going to flatten and possibly go down than just keep going on this rocket ship up into the sky as far as prices go. So that's one reason why I'm selling. I think this is a wise time to do that. I'm even going so far as to contemplating selling my place and then actually renting for a period of time, waiting for what I think is likely to occur in terms of things softening and being able to get a little bit more of a deal off some segments of real estate. I'm not sure that'll happen in every market. There may be some local Silicon Valley markets that are more resilient. But some of the ones I have my eye on, I think are likely to see a downturn. So I want to take advantage of that. However, the other way to solve a lot of the problems we're seeing here are for folks who own deciding to sell. And according to the article I came across, more Americans think selling is a good idea. Now, let's see. We got a record high in May, according to Fannie Mae's latest home purchase sentiment index. And this is something we cover as regularly as it comes out. It's based on a survey of about 1,000 people with their views about the housing market. And according to Doug Duncan, Fannie Mae's chief economist, high home prices have led many consumers to give us the first clear indication we've seen in the National Housing Survey's 7-year history that they think it's now a seller's market. However, we continue to see a lack of housing supply as many potential sellers are unwilling or unable to put their homes on the market, perhaps due in part to concerns over finding an affordable replacement home. Prospective home buyers are likely to face continued home price increases as long as housing supply remains tight. Now, overall, Fannie Mae's home purchase sentiment index dropped 0.5% percentage points in May to a reading of 86.2. 3 of the 6 index components posted larger net decreases than the 3 components that posted increases. The index, however, is still up 0.9 percentage points compared to a year ago. So if we start to see sellers deciding that whatever move they're going to make, if we get them commonly starting to believe that we may be hitting a peak, and if they want to make their move, now is the time to do it, then we would start to see more homes coming on the market. Now, that could explain a bit of what I have seen in the markets that I serve, in Morgan Hill, Gilroy, and San Martin. We've seen an uptick in the number of homes that are listing, but I'm just not certain that we can call that a trend yet. I'm seeing more than I saw last year. We'll see how that goes. I think we'd need, in order to sort of catch up, right? The sellers have been very dormant for several years now. And I think in order for that to sort of jump into gear, I'd need to see something more than a 5% increase in the number of homes or a 5 to 10% increase. I think I'd need to see something above that for me to take notice and think this could be something substantial. Okay. I wanted to share with you a few of the numbers they've got here. 27%, that's the net share of Americans who say now is a good time to buy a home. That's an 8 percentage point month over month decrease and a new survey low. So that indicates a tendency for us to see, at a time of the year when this is not what you normally see, we would expect to see more people shying away from buying, to the tune of 8% less than just a month ago. 32%, the net percentage of those who say now is a good time to sell, is a 6 percentage point month over month increase and a new survey high. So you've got this is a great combo. Okay, in terms of creating stable markets, right? Let's not put on our buyer hat or our seller hat, because we obviously have a vested interest if we're a seller, right? We want to sell it for the most we can. But this is a good way to see these two numbers going, to see buyers less interested in buying and sellers more interested in selling. From a balanced market standpoint, that would tend to push us more into a place where prices would tend to stabilize or go down. Now, here's the downside. This is all a question of volume, right? If I'm talking about a 6 percentage point increase in the number of folks who say this is the time to sell, and the number of folks who are selling is already really, really small, that's not going to compensate us or overcome the larger number of buyers who are out there saying now is not as good a time to buy. So in other words, my point is, even if we see the percentage of buyers drop by 8% and we see the number of sellers increase by 6%, those weren't equal to begin with. Buyers extremely outnumbered sellers. And unfortunately, it still leaves us in that unbalanced scenario. Is it still good? Yes, because the reality is the more folks there are interested in a single property, the higher the price tends to go when the bidding starts to get engaged. If we start seeing situations where maybe it takes a little bit longer to get a home sold, maybe instead of having multiple offers, you're getting offers that are a little bit more aggressive. I am noticing, as a more common occurrence, prices of homes being dropped and homes selling for under asking price or right at asking price. Now, a year ago, that was not happening. I was not seeing homes dropping their price. I was seeing homes going for, on average, 1 or 2% over asking price. So that's interesting data to know for my area. Now, this is something you can absolutely get access to in your area. It might be easier for you to simply connect with a local real estate person who can provide you with this kind of data on a regular basis. But you can absolutely not only figure out what's happening right now in terms of the trends in your market going back just over the last year, but you can even have that person probably compile data for you going back a decade so you can see some of the bigger trends in your local markets. Next, 40%. That's the net share of Americans who say that home prices will go up. That's a 5 percentage point drop. So mix that with what we just talked about. Sellers say it's a good time to sell, but a larger number of them believe that home prices will drop, right? Fewer of them think prices are going to continue to go up. That's kind of interesting. That might create a sense of urgency on the part of sellers to do it now. If you believe that it's a good time to sell, but you also believe, or an increasing number of you believe, that prices will not go up, that might inspire you to go ahead and jump in and sell. The next number is the net share of Americans who say they are not concerned about losing their jobs. Now, that's a 6% drop month over month, meaning fewer people are now unconcerned about losing their jobs. So it's still a healthy number. 71% not concerned about losing their job. But it's lower than it was. More people are concerned about losing their job. Next, the net share of Americans who say their household income is significantly higher than it was 12 months ago is up 5 percentage points month over month. And that stands at 18%. So 18% of the folks believe that their household income is significantly higher. Now, one other interesting thing to note is that for the last 2 quarters, real buying power in the household has actually gone down. So that's a concern, right? In terms of what you actually get for the money you spend, that has dropped. So, and for all intents, that's like getting a pay cut, right? If your money buys less, then you're able to do less with it. All right, folks, we're going to take a quick break, but when we come back, we're going to talk about another assault on creating a ridiculously loose environment in terms of being able to borrow funds. Fannie is loosening their mortgage requirements. So we're going to talk about that in a second. Don't go away.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right. Aside from hosting this show, I am also the owner broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. As promised, we're going to talk a little bit about Fannie. We brushed by this information. I think the first time this came across my desk was probably the end of last year. And it's all going to happen on July 29th. The debt-to-income ceiling for qualifying for government-sponsored financing is going to go from 45 to 50% on July 29th. According to them, the move could pave the way for a larger number of new buyers to qualify for a mortgage, particularly millennials who may be saddled with student loan debt. So remember what we talked about before. None of these types of things, whenever they're loosening mortgage requirements, remember we by definition, that is enabling people who would not qualify to borrow. And this is just one more thing. This is one more brick in the wall of things that they have done to degrade the standards relating to lending. Now, if we refer to it just like that, if we just think of it as a thing that degrades the standards of lending, well, we could use the exact same term to describe all the things they were doing prior to the last downturn. All the 110% loans, all the stated income loans, all the crazy stuff that was going on were just ways to expand lending, right? Well, and these are the exact same thing. We somehow feel comfortable getting the exact same outcome that screwed us over last time, as long as we somehow nudge ourselves to some slightly different path to achieve it. When what you're going for, what you're trying to achieve, lending more money is the problem, not the way that you twist the rules so that more folks can borrow. The fact that you loan more folks to people who are not qualified is what the problem is. According to this, Fannie Mae, Freddie Mac, and the Federal Housing Administration have exemptions that allow them to buy or insure loans with higher ratios than the federal rules, which are set at a maximum of 43%. The FHA allows debt-to-income ratios of more than 50% in some cases. Fannie Mae researchers looked at more than a decade and a half of data from borrowers with debt-to-income ratios in the 45 to 50% range. They found that a significant number of these borrowers had good credit and were not prone to default. According to Steve Holden, Fannie Mae's vice president of single-family analytics, we feel very comfortable. What we're seeing is that a lot of borrowers have other factors in their credit profiles that reduce the risks associated with slightly higher debt-to-income ratios. For example, these borrowers may make higher down payments or have cash reserves of 12 months or more. So that's all wonderful, but I went and looked at this, and I could not see anything that says, okay, if you have a 50% debt-to-income ratio, you have to have a higher down payment or 12 months of reserves in the bank. I didn't see that as a standard. Now, if they want to inject those kinds of standards, well, maybe that's okay. A lot of lenders are saying they're happy to see Fannie loosen up their debt-to-income guidelines a bit. Joe Petrowski from Right Track Financial Group in Hartford, Connecticut, calls the move a big deal for potential buyers who are currently being rejected for mortgages. There are so many clients that end up above the 45% debt ratio threshold. Yeah. And that's a problem. So here we are. This thing that is annoying about this is all so familiar, right? It's like watching your kid stick their hand in the fireplace. Ow. Right? And then they come back 15 minutes later and stick it in again. The first time you feel sorry for your kid, right? You kiss the boo-boo. You try to make them feel better. The second time, maybe you're going to wonder a little bit, how did they get so stupid? Who to blame? Do you blame yourself? Do you blame someone else in the family? I have no idea. Sorry, that's a weird tangent for me to go on. But anyway, you get my point. And even yourself, when you do something stupid and you do the same thing again and get the same result, you probably on the inside are feeling a little bit goofy for having done that same thing again, thinking somehow you'd end up getting a different result. And this isn't us flipping a coin where we may get heads or we may get tails. This is us doing things where just about every time that gets done, we get hosed. So it's really not even a gamble. It's a thing that causes trouble for us just about every time it happens. Finally, let's put on our fortune teller hats for a minute, because we're going to tell you what to expect from the national index. That's right. How much growth should you expect to see? Now, this comes to us from Zillow's forecast. This is the Zillow April Case-Shiller forecast, and they are expecting a 5.6% increase in the national index. So, for those of you who are looking at what might happen down the road, if some of the things we're talking about in terms of anticipating bad things, you think those are going to be further, and that's a perfectly reasonable position to take. Given enough time, what I am suggesting will happen. But the timing could be off, right? Depending on what actions get taken, what things happen. There's a lot of wild variables out there that could shift this around. And the trick is for folks to try to pick the right moment, right? So if I'm off by 5 years, I could really get hosed by taking actions that I'm planning to take relating to my property. If things just continue to grow at these rates, like another 5.6% over the next year, well, that's a bummer. And that's really going to cut into the funds that I might put aside and hold on to, waiting for the market to go down. Let's see. According to the April Case-Shiller forecasts, home prices will finally catch a break in April when Zillow's April Case-Shiller forecast expects growth of 5.6% in the national index, slightly lower than its 5.8% year-over-year climb in March. The seasonally adjusted month-over-month pace also is forecast to drop to 0.2% in the April, following a 0.3% climb in March. Annual growth in the smaller 10 to 20 city indices, which was flat in March, is expected to accelerate slightly. The 10-city forecast is for a 5.4% gain in annual growth for April, following a 5.2% annual growth in March. The 20-city index is projected to gain 6.1% in April, below its 5.9% annual. Now, these are interesting numbers to look at because in addition to it saying expect growth, what they also calibrate us to is this idea that we should also expect slowed levels of growth. Now, the only question that remains in our minds is how accurate is this? And is this tendency towards expecting this to be a slow shift reasonable? Yeah, I think we can all envision a scenario where that's what happens. But I'll tell you what, given all the things that we've talked about, all the things that are currently happening, the amount of debt that folks are holding in their households, all of these various elements, there are so many of them that if one of them goes boots up, if one of them goes bad, it could spell a dramatic change, a very quick change, the kind of thing that could happen within a relatively short time, a couple of weeks, a month, something that could really hit the market hard. And that's really that's the wild card, right? How do we prepare for that? And I know in my own life, my expectation is that we're going to see something like this, something that they're going to flatten or slow down. It may take a little bit longer than I'm anticipating in my head or that my paranoia is fueling. But I believe this is something that's going to happen. And frankly, I think that a scenario for me personally is one where I'm able to purchase investment properties where I'm a little bit less leveraged. I'm doing math on these in a way where, or I'm able to purchase in such a way that I have more elbow room on my rents. And even that should be more than comforting for folks who are investing. Why? Because if we see the same phenomenon that we saw last time, we really won't see a drop in rents. Rents might freeze, but the effect on rents was relatively short-lived. There was a little bit of a dip, but then they stabilized very quickly and just went up. The folks who really made out in the last downturn were the folks who were renting places. And even folks who started right when everything started going down, even folks who'd been holding on for a long time, even folks who bought at relatively high levels before that, were still able to make ends meet. Now, granted, if you bought right at the peak, you were super leveraged, you might have had a period of time where it was difficult. But I know an awful lot of investors who had maybe 20% into a property that they bought the year before things went down, and they were able to go right through and continue to rent at those levels, and be able to be at least positive cash flow to some degree. So I think a better insulator is going to be renting. It's all up to you. It's up to the risks that you're willing to take. Another option is to do flips, but I think if you're someone who does flips and you think there could be a reality to this in terms of a rapid decline, if something very bad happens, I think you need to embrace a strategy where you're flipping those things really, really fast. And that can be difficult. There are some places where you can't really flip it that fast. Lenders don't want you to flip it in a really short period of time. But anyway, more stuff to think about. I think as more news comes out relating to some of the changes that are happening in lending, I'm really anxious to see how these changes affect the number of buyers on the marketplace. And I'm particularly hot to see if these numbers relating to how sellers feel about the market translates into more homes being listed. So, of course, I'll be keeping an eye on all that and share it with you as it comes in. So there you go. Thanks again for listening, everybody. I do truly appreciate it. And I'll talk to y'all next time.